Good evening, everyone. Time for another silver update. This is the 30-minute chart of silver provided by natdania.com. You can click on the link below. Now, I got a lot to cover tonight, so I'm going to go fast and furious, and hopefully you can follow along. We had some big news coming out of Europe today, and that's the German decision on the ESM. I want to look at the ESM really quick because it's a very confusing thing. We want to understand that, and when we look at this, you'll see it's really not something you can understand. But the ESM stands for the European Stability Mechanism, and I'll read a little bit here. The European Stability Mechanism is a proposed international organization which, if established, will provide financial assistance to members of the Eurozone in financial difficulty. The ESM is intended to replace existing temporary funding programs, the European Financial Stability Fund, the EFSF, and the European Financial Stabilization Mechanism, the EFSM. It is proposed to locate the ESM in Luxembourg. The ESM will be established if member states which represent 90% of its capital requirements ratify its founding treaty. As of the 1st of August 2012, 14 of the 17 members of the Eurozone, constituting just over half of its capital requirements, have ratified. Of the remaining members, Italy and Germany must ratify the treaty if the ESM is to be established, as each represents more than 10% of the ESM's capital requirements, and together over 45%. So there's your big quandary. They state very clearly that each, Italy and Germany, represent more than 10%, but combined they represent over 45% of the total. Estonia, the third state which has yet to ratify, has only committed 0.19% of the capital requirements, so the ESM can be established without their ratification. So that's a very strange way of putting it. Something is amiss with these numbers. So if you can explain it to me how the two represent just over 10%, but together they represent over 45%, go ahead and give me the explanation, because I don't have time to go into it. So the main topic of the night is going to be fundamental and technical analysis. Now, first we want to go to the silver chart. I receive a lot of heat, and it's on a regular basis from, I would not necessarily term them fundamental traders, but traders who don't believe in technicals. Whereas I also receive a large amount of criticism from technical traders who don't really accept the fundamentals. So I wanted to delve into these two ideas to explain to you what they mean and how they work. And probably the first place to start, well, before we do that, we want to take a look at the raw numbers from Harvey Organ. And the reason why I'm going to do that is this is going to give us some of the fundamental picture. But if you read the latest from Harvey Organ, this is linked on the blog, you can click on it. And he tracks the open interest in both the gold and silver contracts. So what I did was just summarize all the numbers that Harvey gave, the latest numbers of the open interest for gold, the open interest for silver. And what I did was a simple calculation. It's here on just this little scratch pad. And you can see that the top is gold, and you have 460,000 contracts roughly. Your gold contracts are in 100 ounces, and the price of gold is about $17.32. So the current open interest for gold is about $80 billion. Now, the numbers from Harvey Organ on silver are 121,000 roughly outstanding open interest silver contracts. We know that the silver contract is 5,000 ounces, and we're looking at a rough price of $33.23. That's about $20 billion. So just looking at these two figures, if we look at the Eric Sprott dollar for dollar analysis, we would have to say, based on just this alone, we're talking about a 4 ratio, a ratio of 4 times. In other words, the amount of money in paper gold is 4 times the amount of money in paper silver. So that would give us a price on silver of roughly $132 if it were valued equally to gold dollar for dollar. That's just based upon the outstanding COMEX contracts. That's just one piece of information. That's going to get to the fundamentals. We're going to look at that in a little bit. But before we do that, I want to look at the fundamentals of the SLV and the GLD. You can see here, pretty simply, we're just going to look at straight market cap. The market cap on the SLV, these are people who are investing in paper silver. These are people who are convinced for one reason or another. Now again, these people may be convinced by a fundamental reason, even though they're not investing in fundamental silver, or they may be convinced by a technical reason, a movement in the charts, to invest in this paper asset. But you can see nevertheless that the value of paper silver for the SLV is roughly $9 billion. Now the GLD, on the other hand, is a $65 billion. So you're talking about a roughly 8-fold ratio. If we use that ratio and say that we have a dollar for dollar investment in gold and silver, and again, this gets back to the fundamentals or the fundamentals. If people believe the fundamentals for silver, then eventually silver will catch up with gold dollar for dollar. That's an 8-fold increase, and we're talking about a price of roughly 24 times 8, or I'm sorry, 3 times 8 is 24, so we're talking about a $250 price. So that's roughly twice the other price if we're looking at these numbers. So based on the paper SLV and GLD, a dollar for dollar would yield us a price of $240 for silver, whereas if we're looking at the Harvey Organ numbers for gold and silver contracts, then we're going to be looking at about 120. So silver should be $120 to $240 based strictly on those numbers if we assume a dollar for dollar investment ratio. Now there's a lot of other things involved. It's my contention that there's actually less physical silver available, and I think those numbers are actually on the low side. So we're probably looking at, again, at that $500 price. But let's get over to the main topic of the night, and that's going to be the fundamentals versus the technicals. That's a very hard topic for people to grasp. And so I'm going to start with the grandfather, the godfather, the man who influenced everyone who's ever been involved in all markets in the 20th century, and that's going to be Jesse Livermore. So Jesse Livermore is going to come in and explain the technical side. I'm going to go ahead and look at Ed Seykota, who is a very important figure on the technical side, and then we're going to look at Jimmy Rogers, who is a very important figure on the fundamental side. But this is Jesse Livermore, and remember that he is the grandfather of both technical and fundamental trading, because he did both as well as market manipulation. So he was the grandfather of all market trading regardless. But let's look at his comment here about the technicals. And he says, "That is how I first came to take an interest in the message of the tape." That's technicals. "The fluctuations were from the first associated in my mind with upward and downward movements. Of course, there is always a reason for the fluctuations, but the tape does not concern itself with the why and the wherefore. It doesn't go into explanations. I didn't ask the tape why when I was 14, and I don't ask it today at 40. The reason for what a certain stock does today may not be known for 2 or 3 days, or weeks, or months. But what the dickens does that matter? Your business with the tape is now, not tomorrow. The reason can wait, but you must act instantly or be left. Time and again, I see this happen. You'll remember that HoloTube went down 3 points the other day while the rest of the market rallied sharply. That was the fact. On the following Monday, you saw that the directors passed the dividend. That was the reason. They knew what they were going to do, and even if they didn't sell the stock themselves, they at least didn't buy it. There was no inside buying, no reason why it should not break. So that's a classical technical explanation. When you look at a chart, you have to understand that we can speculate why we have these breaks. We can speculate who did the selling. We can speculate on a lot of things, but the fact of the matter is that this selling was done, and the tape and the volume, especially the volume, the price of the tape and the volume indicate what happened. These are real prices in real time. Now, a lot of people, including Big Square, are going to come out and say, well, it's all rigged. Well, no, that doesn't explain it all. Remember, these prices are arbitrage to physical silver. So you still have Gainesville Coins, Provident Metals, APMEX, and a whole host of other dealers who are marking their physical silver inventory to these prices. So these prices are not irrelevant. The technicals of these prices are not irrelevant, and the fundamentals of why they move are not irrelevant. So let's go and look at the king of, in my opinion, the king of the technical traders, and that's going to be Ed Seykota. Ed Seykota was interviewed in Market Wizards, the original Market Wizards. There are a number of other Market Wizards books, but the original Market Wizards book was the one that interviewed Ed Seykota and Jimmy Rogers and Paul Tudor Jones and a number of the other top traders. These are men who have made hundreds, thousands, and even 10,000-fold on their money, their own money. These are not people like Soros, who was Rogers' partner, who happened to ride along for the ride. But these are real traders who took their own money, risked their own money, and made millions of dollars, and not millions, but thousands of percentage fold returns based on their own judgment. These are the top traders, and this is with Ed Seykota. And I'll read a little bit introduction. Who is Ed Seykota? Ed Seykota is one of the pioneers of computerized trading systems and has been extraordinarily successful with a combination of technical analysis and trend following. So he's strictly a technical trader. Jack D. Schwager writes that Seykota is, quote, one of the best traders of our time. Seykota claims that one account that he managed in 1972 started with $5,000, and over the course of 16 years he's achieved a return of over 250,000% on a cash-on-cash basis and several million% after adjusting for withdrawals. And by the way, he closed the fund because there was too much money to trade. His interview is worth the read for traders interested in implementing a systematic trading system. Without divulging trade secrets, how have you been able to so spectacularly outperform standard trend following systems? And Seykota says the key to long-term survival and prosperity has a lot to do with the money management techniques. Now, these technical traders are going to cite money management techniques. That is talking about letting winners run and cutting losses short. That's going to be the key to technical trading. As Seykota says, there are old traders and there are bold traders, but there are very few old, bold traders. Now, there's a lot in this interview, but what we want to get down to is his view as a technical trader of the fundamentals. And this is Seykota's reply. What are your thoughts about using fundamental analysis as an input in trading? And Seykota says, fundamentals that you read about are typically useless, as the market has already discounted the price, and I call them fundamentals. However, if you catch on early before others believe, then you might have valuable surprise mentals. So Sakota is a very deep guy. You have to read what he says over and over and over again to understand what he's talking about. But what he's talking about is that the price in markets is determined by the number of people who are buying or selling, and that's all in the tape, as Livermore said. We don't really care why they're doing what they're doing. We care what they're doing. And the technical trading is based upon trends, and the trend in silver is clearly up. There's been massive corrections, and of course these type of corrections are for the very purpose of sending out the technical traders. The technical traders would have come in somewhere in here, and most of your true technical traders are long. Now, that is the technical trade. The technical trade is based on the idea that the price knows things that you don't know. That there are insiders who are doing things that know the future, and you cannot possibly know what they know. If you listen to Lindsey Williams, he's a type of person who has supposedly a pipeline to the insiders and why they're doing what they're doing. Sakota's position is, and Livermore's as well, is that you can't know those things because you're not an insider, but you can look at the tape, and the tape will tell you what they're doing. Now, the exact opposite of this position is going to be Jimmy Rogers. Jimmy Rogers is a pure fundamental trader. And the striking thing about this, and the thing that really blew me away when I read that book, and I've read this book, The Original Market Wizards, probably it's the only book that I've read as much or more as I've read Reminiscences of a Stock Operator by Jesse Livermore. And by the way, at least 50% or more of the traders in this book directly cite Jesse Livermore as a inspiration, whether they are fundamental or technical traders. So, but this is the interview of Jim Rogers from Market Wizards. Jim Rogers is strictly a fundamental trader. And you can see here, I'll read some of the description. Jim Rogers is perhaps the most well-known trader interviewed by Jack D. Schwager in Market Wizards. Rogers and George Soros founded Quantum Fund in 1973, one of the longest-running and best-performing hedge funds in the world. Jack D. Schwager was eager to interview Rogers, quote, because of his stellar reputation as one of the shrewdest investors of our time. Now, that ought to give you a clue. Rogers is described as an investor, not a trader. And Rogers is unique in the sense that he is one of the only traders interviewed in the book that considers himself a bad trader. Rogers says, quote, I am probably not the person you want to interview. I often hold positions for many years. Furthermore, I'm probably one of the world's worst traders. I never get in at the right time. Rogers' humble response does not change the fact that he is widely considered as one of the most famous and successful traders of our generation. And we go into the interview. Now he's talking about the fundamental strategy of Rogers. And Rogers says, whenever I buy or sell something, I always try to make sure I'm not going to lose money first. Okay, so there's a fundamental trader. He's buying something that is undervalued. It's so undervalued that he can't lose. If there is a very good value, then I'm probably not going to lose much money, even if I'm wrong. Question. It sounds like you have a great deal of conviction when you put on a trade. Yes, I usually do. Otherwise, I don't bother doing it. One of the best rules anybody can learn about investing is to do nothing. Absolutely nothing, unless there is something to do. Most people, not that I'm better than most people, always have to be playing. They always have to be doing something. They make a big play and say, boy, am I smart, I just tripled my money. Then they rush out and have something else to do with that money. They can't just sit there and wait for something new to develop. Question, do you always wait for a situation to line up in your favor? Don't you ever say, I think this market is probably going to go up, so I'll give it a shot? Quote, what you just described is a very fast way to the poorhouse. I just wait until and this is the essence of Jimmy Rogers trading, I just wait until there is money lying in the corner, and all I have to do is go over there and pick it up. I do nothing in the meantime. Even people who lose money in the market say, I just lost my money. Now I have to do something to make it back. No, you don't. You should just sit there until you find something. Trade as little as possible, and it goes on. So that gives you a peek into the minds of these types of traders. Now, there actually are other types of traders, but these are the two primary types of traders. You have technical traders who are looking at the technical picture of the market. They're not interested in the reason why people are doing things. They're interested in what the price, what people are doing, the price and the volume. And their idea is that you cannot possibly know those reasons until a much later time. What your job is to do is to watch what they're doing and piggyback them and get on early and make a quick profit before they change their minds or until the trend changes. That is technical analysis in its essence. Fundamental analysis, on the other hand, is the view that Jimmy Rogers takes, which says that you need to find an undervalued asset and you need to buy it as much as you possibly can. So looking at the silver chart, we can add some arrows. Jimmy Rogers might have bought in here. I bought there. And there. And I bought there. I stopped buying at those peaks. Jimmy Rogers probably bought here too. I bought there. And I bought there. But the point is this. This is an undervalued asset. It doesn't matter, according to Rogers, when you buy it. It matters that it's undervalued. Ed Seykota, on the other hand, he bought there, and he bought there, and he bought there, and he's buying right now. So the important thing for you to take away from this is the understanding of the difference between fundamental and technical traders. There are billionaires on both sides. Ed Seykota and Jimmy Rogers are the best examples of those two types of schools. And what is absolutely fascinating about silver is that it is both of those at the same time. It is, at this point in time, an incredible technical buy based on these technicals, and anybody who knows the fundamentals knows that silver is the greatest fundamental story in the history of the world, and it's just simply a can't-lose situation on both a fundamental and a technical basis. And we'll talk to you next time.